Hi, I'm Kevin Harrington, an original shark from the hit TV show Shark Tank. And with me is Adam Schwartz, the CEO and founder of the Merchant Marketplace. Adam, welcome. Good having you here.
Thank you, Kevin.
I need to know, what is the Merchant Marketplace?
That's a great question.
Okay.
So the Merchant Marketplace, we are America's premier merchant cash advance business.
Cash advances for businesses, not individuals, businesses.
For businesses, correct.
Got it. Okay.
And
it's a big need out there for this.
A huge need. As a matter of fact, let's go to 2008 when banks had a crisis and they stopped lending money to businesses.
Right.
At that point, you had 15 million businesses, small businesses, that didn't have access to capital. The banks weren't lending.
Right.
And at that point, they said, there's a need for merchant cash advance. We come in within 24 hours, we can actually fund a merchant.
Wow.
And what happens today, so let's fast forward to today.
Right.
We get hundreds and hundreds of applications. And we're not banks, we don't have the deep pockets the banks do, but we want to be able to fund America's small businesses.
Gotcha.
And we thought about what's the best way to be able to be every merchant who comes in the door, to be able to fund each and every merchant. And what we did is we created a syndication platform to make that a viable concept.
A syndication platform.
That's
so,
correct.
In other words, the merchant, you have the platform. What is the syndication platform?
So basically, sure, the syndication platform is a peer-to-peer platform similar to like a lending tree or so in the syndication platform, what we do is we have merchants who come in the door, they need capital. But on the other side, we have syndicates and investors, mom and dad, brothers and sisters, uncles and aunts.
Part of
the peer part of it, right.
Friends, relatives, or business associates, or anybody that's interested in potentially getting a return on their investment, I guess,
Correct.
Is what happens here,
Correct.
right?
And we look at this so much more than an investment. So you have the banks that kind of fell short. You have all these businesses. If there is one ding, let's say for argument's sake, you're 40 years, you're a business owner, you missed one payment last year because, let's say, you're a seasonal business.
Right.
And you had to close down for a couple months. You're a gardener in New York, right?
Right.
No need for that. And you missed a payment. So what the banks do, they'll penalize you, right? It doesn't matter that you had 40 years of good credit. You have one bad payment, and that's it. They won't fund you. And it's a very unfair system.
Yeah. So the platform, what I love about this is a business that's a going business. They got cash flow. They need a little bit of cash. Things have been tough over the post-COVID now.
Sure.
You put them on the platform, and now peer-to-peer, there may be people in the neighborhood that say, oh, I go to that restaurant or I go to that garden store and say, I'm going to loan some money through this peer-to-peer syndication platform network,
absolutely.
Right? So how does a deal get structured, and what is a typical kind of a deal?
So typically when we look to fund merchants, what we do is we'll fund anywhere between 3 and 9 months, with the average being about 6 months.
Right.
And the reason that we do 6 months is because when we look at a merchant before we fund them, we look to see the past 6 months of their revenue, we look at their finances, and typically if we see a linear or an upward turn in their revenue, right, they're a good candidate for funding.
Gotcha.
If there's a downturn in a market or in a specific locale, it takes about 6 months for that to kind of set in.
Right.
So for us, when we give money to the merchants, in that 6-month period, 90% of the time, they're going to be able to pay it back. There's going to be no issues in terms of defaults or missed payments.
Yeah.
So we kind of miss that negative business cycle, and that's why we keep it around that 6-month mark.
Gotcha. Go ahead. Anything else you want to say?
Sure, of course.
Yeah.
So in terms of, let's talk about the cost of money, right?
Gotcha.
So obviously, banks are much lower. We're using, again, friends, family, things like that. So we do not charge interest. What we do, we charge what we call a factor rate. And with a factor rate, it's a one-time fee that's assessed to the amount that we're fronting the merchant, that we're giving the merchant.
Gotcha.
Okay? And typically what happens is we're getting back money either daily or weekly from the merchants, and that's how they pay it back. We have something called an ACH system that pulls it directly from their bank into our bank, right, and pays us back over the course of, let's say, that 6-month period.
Okay. So it could be as a daily
repayment.
repayment.
Absolutely.
Which you don't notice it on a daily basis.
Correct.
Because it's a small amount, right?
Correct. It's a fraction of their income, and that's why it's manageable for the merchants.
Right.
Now let's talk about mom and pop and why there's 2 huge benefits why this peer-to-peer platform really does work. One is that you have, again, mom and dad, cousins, relatives, uncles, friends, who can now invest in America's small businesses, right? They're helping the local businesses, they're helping the communities, and there's a real sense of gratitude from the merchants, and you get such a sense of satisfaction to be able to help businesses where banks and even the government, the SBA, is not doing it. Right. So there's a sense of real helping people.
Yes.
The other part of it is that the returns really outperform anything that's in the market today, right?
Wow.
Because think about this, if we're in terms of what we charge, again, we'll charge anywhere from 35 to upwards of 50%, right, in payback over the course of that, let's say 6 to 9 months time period. So if you're an investor on this peer-to-peer platform, you're getting the lion's share of that return.
Gotcha.
So it's a huge benefit, right?
That
so you're
makes
helping
sense.
companies,
Right.
you're helping people, you're helping communities, and you're getting a tremendous return on your investment.
Investors get a good return. Now, you mentioned a word with a D, default. Okay. I got to ask you, is there any significant problems in this area, in the default side of things, where they can't pay?
Right. It happens. And let's discuss, why does a merchant typically default, right? So we talked about usually there's a 6 months turnaround period when markets start to decline, or an industry or a market will kind of decline. So what we find is most companies that take money, or individual business owners that take money, they have every intent in paying back, right?
Right.
So we see certain industries at certain times will have issues, and when they have issues, 95% of the cases they'll reach out to us, we'll restructure payments, we'll work with them. Our first line of defense is to always communicate,
Gotcha.
work with the merchants, and work out some kind of repayment plan.
Right.
And that's always. But unfortunately, there are times when things do go bad, trucks die, industry, business owners get sick. Yeah. And it does happen. So typically we'll see about a 10% default ratio in the industry.
You can deal with 10% because you can bake that into the whole business model, right?
Correct.
And and I think it sounds like the investor is obviously a very important part of this, because without the investor, there's no money to give to the business, right?
Correct.
So investors want to know, what do I make, right?
Sure.
What's the deal for me, right?
Right.
So let's say an investor puts up $50,000. Mm-hmm. Is that a typical type of an amount that a business might need, 50,000?
Right. So we can look at it from two perspectives. So a company that we fund will need 50,000, but the way the syndication platform works and the way that it thrives is like this. So let's say you're an investor and you come to me and say, listen, I want to invest $50,000 on the platform.
Right.
What I would say to you, Kevin, here's how we're going to do it. We're going to put you in 10 to 20 deals. Right?
Okay.
We're going to keep that fixed amount. Let's say we're going to do $5,000 per deal or $2,500 per deal. This way, if you're in every deal, you're seeing anywhere between 35 and 50% returns on each merchant that we fund.
Gotcha.
Right? And you're also not leveraging too much into any one company.
Right.
And if you look at the math, right, if it's a 10% default, so you realize 10% is going to go bad, but on the other 90%, right, you're getting those significant returns.
Yes.
So as long as you do it in an even keel type of way, you're going to be successful.
I like that. It's sort of like when you're buying stocks, you don't put all your money into one stock that could go up or way down and you lose it all. So here you get kind of leverage it against the rest of the platform. And so how often does that platform pay?
So what we do is we give complete flexibility to the investors to be able to kind of determine that, and I'll tell you why. So we can pay back daily, weekly, monthly, or kind of like let it ride, let the money stay in the portfolio. The best way to see the best returns on a platform, on this peer-to-peer platform, is by reinvesting the money as it comes in.
Gotcha.
Think about this. If we're getting back returns every single day, and every day we're taking that same monies and we're putting them back on the street, we're exponentially increasing our returns.
Yeah.
So that's the best way. But you have complete flexibility to do whatever you'd like.
Yeah, that's great. Now, I know as a business owner, you've created some sophisticated tools,
Sure.
and you have an app and a portal for investors and
Yes.
things like this. Maybe we can we got a beautiful television. Oh, and it is a beautiful
That's
screen.
fantastic.
Teasing about that, but no. Maybe we could you walk me through the platform?
Yeah, I would love to. The key to any platform is transparency, right?
Yeah.
We want to make sure that our investors, our syndicates that go into this have every perspective to see every analytic, every dollar that comes in and out of the portfolio. So I'll kind of run through this kind of quickly with you, just so you get a little feel for the way it works. If you look on the left-hand side, you could add money to the portfolio. In the wallet is the liquidity. There's money that comes into the accounts. There's money that goes out of the accounts, pending to the bank, pending to the merchant marketplace. The principal investment is the amount of money that you've invested from the inception of the portfolio. Mm-hmm. The projected portfolio value is what that value is today in this current state.
Yeah.
Okay. If you move over to the left-hand column, you'll see, again, you have the projected portfolio value. Under it, you have anticipated RTR. RTR represents the right to receive. That's the return that you're going to get on your investment. Okay. Currently, the current invested amount today is $53,831. Okay. And on that, which is myself actually, Adam Schwartz.
Yeah, nice.
Right? I'm going to get back $69,000 on that investment. That's the profit that I've seen to date on the portfolio.
Nice.
If we go towards the middle, I have a blended ROI. It's just as a side note, what you could see is, and if you don't know what any of these variables mean, you could take the mouse and just mouse over the little I, and it'll basically tell you what those variables represent.
So you're looking at a 59% annualized rate of return.
Not bad,
Pretty amazing, right? But at the same time, you're offering businesses something that they can't get without going through something like this, because they've been turned down. The banks don't want to give them money based on whatever the circumstances are. This is a great resort, and it's a win-win situation for both sides.
Absolutely. Yeah. Absolutely.
Right.
Default in this portfolio, thank God we don't have any defaults as of yet. And what happens here, I myself take back the monies every day. So I've been paid back to date $27,640.
Right.
We go to the right-hand side. This will give you basically the 5 latest payments that we received in the portfolio. If you scroll down just a little bit, you'll see to the right we have a graph, and just that graph represents month over month how much you've invested, how much you've gotten back, and what you can anticipate to receive.
Beautiful.
Okay? Right in the middle we have the invested industries. If you kind of mouse over the pie chart, you'll see the different industries that we invest in. Okay? So this is the main portfolio and the main variables that you'll see in the investment portal. So moving to banking, right? You have complete flexibility to add as many bank accounts as you want, and you can have a specific account that is your default credit account, and if you want a different account to debit, we can do that as well. And you have complete flexibility to enter that information as you wish. Okay. On the right-hand side over here, payment frequency. This is what goes back to the question you had asked. You can actually determine your payout frequency. Let's say, for argument's sake, today I'm getting it daily, and tomorrow I say, you know what, I want to let it ride. I can click on that where it says daily, and I can change my payout to monthly or weekly or on demand.
Great.
Okay, so again, complete flexibility to do what you want.
Very nice.
Okay, third tab we have is the reports. Now, if you just keep the mouse over there, we don't have to go through it in detail, but I could tell you, you have a payment report that tells you every day exactly what you've received in the portfolio. Your investment report, it'll basically tell you exactly what you've invested into each and every merchant. Okay, your transaction reports tell you how much money has come in and out of your portfolio.
Right.
Default rate report basically tells you all the defaults that we've had and where they've defaulted, because typically, if there's a default, it doesn't happen up front.
Gotcha.
We're going to have, on average, if a merchant is going to default, they start to default at about that 25 to 35% paid-in mark. Right. Which represents close to about 50% of your invested amount.
Gotcha.
So you have complete visibility into seeing, where those merchants are today.
Right.
Okay. Statements, if you mouse over statements, what we do every day, we will send a detailed report that tells you your daily remittances and each and every merchant that you're invested in. Okay, so, and you have complete history from the inception of the portfolio to see all that here, and you can download it and do whatever you like with it.
Fantastic. Nice.
Okay, go to merchants. So if you go to list, right, now these are all the different merchants that I'm specifically invested in.
Got it.
So what we could do, if you want to go to, let's go to number 5, VTech, and we'll see. Right? And I can just walk you through this. So you, as an investor, have, again, so much information, so much analytics into each and every merchant. And you can see this right here. So this company specifically is automobile parts and supplies, RTR on this specific deal, cash to date, what you've received, the balance, you have your factor rate, your specific share in that deal. It actually tells you what percentage of investment you have in that deal. the total amount invested in the deal, where it is in terms of completion. We're about almost 54% paid in to that deal.
Yep.
The profit they've already received from this specific merchant. You have the payment amounts. You have the total amount of payments, the actual payments made, and the remaining payments. The principal that's been paid.
Yes.
Okay, we go to the right. You have a commission. I'll talk real quickly about what the commission is. So typically we get deals from what we call our ISOs. And those are third-party brokers that basically deal with the retail side of speaking to the merchants.
Gotcha.
We're more of a wholesaler where we get the majority of our deals from our ISOs that give us the deals. And we pay commission to those ISOs for giving us
the ISOs.
Correct, for giving us those deals.
Okay.
So when a investor goes into a deal, they actually pay their proportionate amount of the commission so that we can pay the ISO.
Gotcha.
Okay?
Gotcha.
And then these are different fees that would be assessed to the portfolio.
So I'm hearing two sides. You got the investor side and the syndication side, right?
Correct.
And so how does somebody that's out there get to be one or the other? I mean, you might have some that are both, but typically it's two separate folks.
Things.
And by the way, this is amazing. Everything that I'm seeing here. I'm seeing money that's going to merchants that need the money, that can't get it anywhere else.
Correct.
And good returns coming back to the investors with a very small default rate it's all working very well, and I can see some good returns on investment. But so if someone wants to be an investor, how do they do that? If they want to be a syndicate, right? How do they do that?
So here's the distinction between the two. So a syndicate typically is a little more selective in the deals that they want to go into. And they'll say, you know what, I want to go into this deal, I want to go into this deal. And they'll say to me, you know, I want to go in for a specific dollar amount. So they typically have a little bit more savvy. They'll dictate their own terms and their own deals, and you know that's what a syndicate is. Investor is a little bit different. An investor is somebody who will give me a lump sum of money and say to me, Adam, here's what I'd like to do. Give me put me into 20 deals, spread me evenly, and I want to see my return. So we kind of manage the portfolio for an investor versus a syndicate who's a little bit more, wants to be more involved.
Gotcha.
A little more hands-on.
Okay, nice. And so investors that come in, do they pay fees, or how does it, I mean, they're getting a good return.
Sure.
So they're making money. So they have the availability to pay some fees, but are they paying fees?
Right. So both the syndicate and the investor, they're making the lion's share of these returns, And the returns are pretty significant, as we've discussed.
Yeah.
So we have what we call platform fees to be in the platform. Typically, we have something called a 3% syndication fee. We have a 3% management fee. So
syndication fee, management fee.
Right. So the syndication is up front, and the management, as is the payments, come into the portfolio. So where the syndicate or the investor will make upwards of anywhere between that 35 and 50%. We're charging 6%, and they're making that lion's share, really, of the returns on the merchant.
You did say that ISOs get paid some fees,
commissions,
yes. What about referral fees?
Great question. So the way to really get this platform to everybody, and that's what we want to do. We want to make this accessible to everybody. Is if you're on the platform and you have friends, relatives, cousins, whoever, I want to incentivize you to get this platform to them.
Right.
And I'll pay you a referral fee to do that. And what that means is that I'll give you anywhere from 1 to 2 points that are assessed. So when they go into a deal, the system already knows how much they've invested, and you're going to get a percentage of that. That's already assigned in the liquidity to your portfolio.
Very nice, very nice.
Yes.
So I just want to say that this is very clever. And where was this when I was a young entrepreneur? Because I went into banks and tried to get money when I was, when I was 18 years old running a heating and air conditioning business. I needed capital, but the banks, they said, if you have money in the bank, we'll lend you money against that. So I just want to say, for all those out there, there's great opportunities here. If you need capital, if you're a business owner, also, if you're an investor and you want to make a good return on your capital, that's a good point too. So let me just summarize by saying, in today's market, there is truly no better opportunity than to invest in America's small businesses. Not only are you helping business owners grow and scale their businesses, but you're also helping their local communities and families succeed. Best of all, you have full transparency via the app and the portal to track your deals in real time while generating a potentially substantial return on investment. To start investing today, go to merchant syndicatemarketplace.com, click on syndication, and fill out the form. It's that easy. Thank you.